วัสดีค่ะยินดีต้อนรับเข้าสู่การนำเสนอข้อมูลของบริษัท PSL Shipping จำกัดมหาชนนะคะหรือ PSL ของไตรมาส 1 2565 นี้โดยคุณคาลิด ฮาชิมกรรมการผู้จัดการจะนำเสนอข้อมูลในเรื่องของภาพรวมอุตสาหกรรมและตามด้วยคุณกอตัม ภูรณากรรมการทางด้านการเงินในเรื่องของตัวเลขทางการเงินนะคะและในส่วนสุดท้ายในเรื่องของคำถามคำตอบถ้าท่านใดมีคำถามก็สามารถคีย์เข้ามาในระบบได้เลยนะคะเราจะเริ่มเซสชันแรกโดยคุณคาลิด ฮาชิมนะคะ Please start ค่ะ
สวัสดีครับ everybody. We will as usual break up the presentation into two parts. In the first part, we will talk about the industry structure, and in the second part, we will talk about the finances of the company, which Gautam Khurana will take you through. Now, coming to the first question, which is on the top of everybody's mind, is how is the Russia-Ukraine war affecting us? Now, if you look at this slide on the left-hand side, you can see what is the amount in terms of complete exports for 2021 from these two countries. So you can see that they are very large grain exporters, pretty big in steel, pretty large in coal, very large in fertilizers, and smaller amounts in iron ore. If you look at the right-hand side of the screen, you can see that about 45% of all these exports are to very, very close by countries, so very short ton-mile demand. Now, when this war has started, all these cargoes have become captured in those countries and has not been able to export. So if you look from the bottom, sixth row from the bottom, starting with rest of the world, is raising interest rates and tapering QE to combat inflation. China, on the other hand, has cut interest rates, reduced reserve requirement ratios of banks, and has reduced mortgage interest rates. China has also put into place a $2.3 trillion stimulus plan for this year. The second point is that 14.5% of all seafarers are from just these two countries. So if this war drags on, it means that the cost of seafarers for every ship-owning company all over the world will go up. Exports from Russia and Ukraine are to the European Union, Turkey, Egypt, and North Africa in the majority, and these will be substituted by longer ton miles from India, Australia, USA, Canada, and South America. Right now, the European Union is importing more coal than it has done for a long time. If the European Union switches all its gas-based power plants to coal, then the annual import of coal would increase into the European Union by an additional 200 million metric tons, as against their current imports of last year of about 100 million tons. Iron ore exported by Russia, Ukraine to the European Union will be replaced by longer ton miles from Canada, boosting freight rates. And as we have always told you, wars lead to disruptions, which leads to inefficiency. It results in longer ton mile and therefore higher freight rates. Coming to the markets itself, if we look at the main country that imports and exports the largest amount of cargoes, it is China. And if you look at China in the first quarter, what do you see? You see they have been down on every metric that you can think of, whether it's iron ore or coal or steel production or steel imports or steel exports or steel consumption. Everything is down. But you must remember that China has announced a very large stimulus program of $2.3 trillion, and that should help us a lot during the second half of this year and into the whole of next year. If you look at the way the market has behaved from the top, the markets peaked in October. And if you look at the Capesize as an example, it was at $87,000 a day on the 7th of October. And by the 26th of January, it had fallen 93% down to $5,826. From there, it has made a marvelous recovery towards the end of March. But as of yesterday, the rate for the Capesizes was already at $31,000 a day. If you look at the Panamaxes, peaked at almost $40,000 a day or $39,000 a day on the 25th of October, dropped by 59% to $15,885 by the 2nd of Feb, and then had climbed another 78% to $28,273. As of yesterday, they were just below $30,000 a day. If you come to the Supramaxes, peaked on the 21st of October at almost $40,000 a day. Look at it on the 2nd of Feb, it had dropped by 57% to $17,300 a day. And by the end of March was at $31,000 a day. As of yesterday, it was almost close to the same number. If you look at handy sizes, they peaked at $37,000 a day on the 25th of October, dropped by 52%, the lowest drop amongst all the sectors, to $17,800 a day. And then by the end of March, we're back up at $31,000 a day, up 76%. And as of yesterday, they were also around the $30,000 a day mark. So you can say that there was a sharp drop towards the middle, starting in the middle of Q4 last year, and then there was a sharp increase after the sharp drop by the end of the first quarter. On a quarterly basis, on an annual basis, this is what it looks like. What we have drawn up for you are the annual charts for the BDI for 2020, the lowest line. Then the second lowest line is 2021, and then the highest line is 2022, all the way to the end of March. But remember, by the middle of May, it has already crossed 3,100 points. So you can see that we are following the same trajectory as was there last year. This is on a quarter-by-quarter basis, and it shows you again that 2022 looks like a stronger first quarter than the rest of the than last year, and definitely more than the year before. If you look at this chart, it shows you in the third row from the bottom, it shows you what is the growth in trade. Now, according to Clarkson's, 2021 growth in trade was just under 4%, and increase in the dry bulk fleet for the whole of last year was at 3.55%. So not a large gap between demand and supply, yet rates in 2021 were higher than the rates in the last 10 years combined, the average of the last 10 years combined. If you look at 2022, Clarksons are forecasting just 2.1% growth rate. Against that, they are forecasting almost 3% of supply. And yet we have seen, as I've shown you, that rates are much stronger in Q1 2022 as compared to Q1 2021. So we think, and if you look at the forecast for 2023, it's for a growth rate of just 2%, but with hardly any growth rate in supply of 0.43%. So again, it looks like from the macro picture of supply and demand, and taking into account the inefficiencies which have been created thanks to the Ukrainian war, as well as due to COVID-0 in China, this looks like the supply side will be curtailed during this year and next year, whilst demand will be growing at a stronger pace. So we expect good years for this year and next year. If you look at just minor bulk, which is more important for precious shipping because our ships carry more of these cargoes, you can see for last year the growth rate was 5.6% against the supply growth rate of 2.45%. So therefore, you can understand why the geared ships did better last year than the bigger ships. If you look at the forecast for 2022, it's at 2.7% for growth and 2.8% for supply. And as I said, supply will be constrained because of various factors arising out of the Ukrainian crisis, as well as out of China's COVID-0 policy. So we think that the gap between demand and supply will only grow in favor for the owners. Coming to 2023, you can again see that the growth rate is expected at 5.4% versus a supply growth of less than 2%. So again, we should do very well for both 2022 and 2023. Coming to the types of cargoes carried, you can see Cape sizes, they carry iron ore 74% of the time, coal 21% of the time, and then they carry bauxite, which is a minor bulk, for 4% of the time because China owns these mines in Guinea, in West Africa, from where they have a loading terminal, and they have Cape-sized ships carrying this cargo of bauxite from Guinea all the way to China and back. If you look at the Panamaxes, they spend 9% of the time on iron ore, 49% of the time on coal, 28% of the time on grains, 13% of the time on minor bulks. If you look at Supras and handy sizes, what do you see? You see that the maximum cargo carried by Supras and handies is in the minor bulk trade, 55% for Supras, 65% for Handysize. If you look at coal, Supramaxes carry 22%, Handys carry 10%. If you look at grains, Supramaxes carry 17%, whilst Handys carry 22%. So you can see clearly that because minor bulk is growing at a faster speed than major bulks are just iron ore, coal and grains. Therefore, for us as precious shipping, we should fare well for this year and next year. In terms of supply growth, if you look at the right-hand side last column, you can see that the growth in deadweight tons for Handysizes for the first quarter was 3.03 million deadweight tons, or 2.76% of the fleet. For Supras and Ultras, 8 million deadweight tons, or 4%, 3.76% of the world fleet. But for the Panamaxes, 9.25 million deadweight tons, or 4.75% of the existing fleet. And for the Capesizes, almost 20 million deadweight tons, or 5% of the existing fleet as of the end of quarter one. So you can see again, supply growth in the smaller sizes is quite constrained compared to the bigger sizes. If you look at the historical data, what do you see? You see that at the start of 2009, the forward order book as a percentage of the existing ships was at the 78% mark. This is the high point, and you can see that quite clearly on the graph, and it's been circled for you. But if you fast forward to 2021 and 2022, what do you see? You see that the red line, which is the 20-year-old fleet at the start of each of these years, is now higher than the forward order book. If you look at the same thing for the Handysize and the Supras, what do you see? You see that the order book is at 3.72 million deadweight tons for Handysizes, equal to 3.3% of the existing fleet. And the existing 20-year-old fleet is at 14%. So you can see that for the Handysize fleet, in the next few years, you will have a shrinkage of the fleet taking place. So no positive growth, but a negative growth in the fleet. If you then come to the Supras and Ultras, what do you see? You see that 15.24 million deadweight tons is on the order book, which is 6.92% of the existing fleet. But the 20-year-olds today are already at 10.10%, which means that whilst cargoes, that is the minor bulks, are growing for the Handysize and the Supramax fleet, the fleet itself for both these sectors will either be stationary or will be shrinking slightly. So looks good for us for the next few years. If we want to compare the various periods of time where we saw things go really high during the 2003 to 2009 period, very low during the 2010 to 2020 period, and then in 2021, where we can see that if you compare, for example, the Handysize, it was at 1.5 times the peak period in 2003 to 2009. If you look at the Supras, almost identical to what was there in the 2003 to 2009 period. On the Panamaxes, slightly below 10% below what it was in the peak period, and for the Capes at 50% of the rate that was prevailing in the past bulk period, in the past period. If you look at Q1, you can see that the Capes did not do too well in Q1, but as I said, as of yesterday, the Capes were back at $31,000 a day. If you look at Panamax, it has also come down compared to last year's average. If you look at Supras, it is almost at the same level at last year's average. And if you look at Handys, again, very close to last year's average. Now, if you look at the demand in billion ton miles per year on an average, in the 2003 to 2009 period, it was growing at 5.4%. In 10 to 20, it grew by 4.2%. Then by 2021, it had dropped to 4%. And in 2022, Clarksons are forecasting a 2.5% growth rate. If you then look at the annual average net supply, that's the last line, you'll see that during the period 2003 to 2009, it grew by 6.8% per annum. In the 10 to 20 period, it grew by 6.4% per annum. By 2021, it had dropped to 3.6%. And in 2022, it's going to drop to 2.1%. And the best news is for last is to compare the existing forward order book to the existing 20-year-old fleet. If you look at that, at the start of 2022, this ratio was less than 1. And you can see that at the start of 2022, that ratio has fallen even further. But if you look at the ratio, for example, in 2003 to 2009, it is more than 2 times, the forward order book was more than 2 times the annual average of 20-year-olds. If you look at it in the 10 to 20-year period, it was almost 2.5 times what it was, what the 20-year-old fleet was. And therefore, you can see now finally in 2022, you have a ratio which is less than 1. These are the forward order books, just to show you what the picture is like at the start of Q2 2022. Total order book is 62.22 million deadweight tons, 6.57% of the existing fleet. And if you then break it down into geared and gearless, you can see on the geared sector, 19 million deadweight tons is on order, or 5.7% of the existing fleet. But for the gearless fleet, it is 43.25 million deadweight tons, or 7.05% of the existing fleet. In terms of congestion, if you ignore the 4 outlier years, 2010, 2015, 16, and 17, the annual average congestion over the last 12 years has been 4.3%. And if you look at 2021, it is not too much higher than that at 4.6%, roughly less than about 8-9% higher than the average for the period. If you look at our results for Q1 and compare the average TC rate for the pressure shipping handy size fleet, it was 20,313, or 15.66% less than the handy size index ship. If you compare the Supramax index and our rates, we earned 5.09% less than the index rate of 25,156. But remember, one of our ships was held up in Lagos in Nigeria for this period of time and therefore did not earn anything. And if you were to exclude that, we would have beaten the index by 0.35%. Coming to our strategy, you can see that our forward book is growing. Today, we have got an average rate for 2022 at $23,816 per day per ship for 4,230 ship days, or 32% of the existing fleet has been booked for this year, and the total contract value is $101 million. As you go forward, you can see the rates coming down and then flattening out to the 15,316 level, which is the 5 ships which are out on 15-year contracts, and they are coming in towards the 10th and 11th years of their contract life. To then look at the overall industry takeaway, you can see that supply-demand balance was reached in the middle of 2021. BDI reached a 13-year high on the 7th of October, starting out at 1,374 points, reaching 5,650 points. Rates improved significantly during 2021. Average 2021 rates were higher than the average of the last 10 years. We think that the market will remain strong during 2022 to 2025, but with extreme volatility because supply-demand balance has been reached. So any excess demand will shoot rates up. Any slight change or reduction in demand will bring rates down very sharply. So market will remain very volatile. New ships ordered during 2021 compared to 2020 was up by 62%, and compared to 2019 was up 46%. This is for the overall dry bulk fleet. But if you just look at the geared ships, it was down by 6% compared to 2020 and was up by 49% compared to 2019. So what was the bad news in 2021 and the start of 2022? The bad news was negative news from China, and then negative news from the rest of the world, like persistent inflation, QE tapering, and interest rate hikes. What did that bad news do? It dropped congestion, and therefore we had a weaker but yet healthy rates in Q4, and with a sharp dip in the start of 2022, followed by an equally sharp rise back in by the end of Q1 2022. Average rates for the index ships in Q1 2022 are stronger than in Q1 2021, except for the Cape sizes, which was slightly weaker. The bad news caused by is caused by government decree and not by a collapse in demand, and therefore can be reversed. China has recently announced a $2.3 trillion stimulus plan, a third of which is in infrastructure development, which means steel, cement, and wood. All these are minor bulk cargoes. All of these are carried by our type and size of ships. We expect by the end of Q2 2022 that China's real estate crisis will have passed. China power will increase. China industrial production will be back up. Chinese GDP will be back at trend. And we may be surprised once again at the strength of the market in 2022, just as we were surprised by the strength of the market in 2021. The financials, Gautam will now walk you through the rest of the presentation.
Okay, so thank you. So here are a couple of highlights. So in 2022, we declared 3 interim dividends, the third one being 50 satang, which was paid on the 11th of March 2022. So apart from 3 dividends, the interim dividends, we also declared a final dividend of 25 satang, which was paid on 28th of April. Total dividend for the year 2021 was 1.75 baht per share. In the first quarter, we entered into long-term charter contracts for 4 vessels at levels linked to the underlying index for vessels of that size. The variable rates under this type of time charter allows us to fully capture the upside in the market, although it also exposes us to the risk of a fall in freight rates. During the quarter, we also entered into a 9 to 11 month time charter contract for 1 Ultramax at a fixed rate of USD 35,500 per day. We partially prepaid a KTB bank loan in the amount of 101.91 million on 31st March. We also actually fully prepaid a loan from BNP Paribas of in the amount of 24.14 million. This was on 5th of April 2022. So this happened after the quarter end, so therefore it's not reflected in the financial statements. So here's our financial profile. So looking at Q1 and looking back also all the way back to 2017, you'll see our cash and cash equivalents position at the end of Q1 stood at a very healthy 81.3 million. That was up from 73.9 million at the end of 2021 and up from 36.6 million at the end of 2020. Our total assets was up to 708.5 million from 704.1 million at the end of 2021. Our net debt came down from 172 million to 151.3 million. And as I said, so that doesn't reflect the prepayment of the BNP loan. Our total equity moved up from 429.8 million to 448.9 million on account of the net profit. Our net debt to equity ratio continues to move down. It's now down to 0.34. That is down from 1.09 in 2017. EBITDA for the quarter came in at a very healthy 49.2 million compared to 175 million in 2021 and 36 million in all of 2020. Our debt to EBITDA ratio also it's moving in the right direction. It's at 1.23 compared to 1.49 at the end of 2021 and 8.4 at the end of 2020. This was on account, of course, of our debt reduction, but also because of higher daily earnings per day per ship, which for the first quarter came in at 21,995 compared to a full year average in 2021 of 20,338 and 8,332 in 2020. And also, by the way, I'm just comparing to 2018, which was also a very strong year. At that year, rates were 11,063. So this is a much, much stronger year than even a relatively strong year, which was 2018. Our daily OPEX came in at 4,914, down from 5,090 for 2021, although up from the 4,705 in 2020. Our net profit for the first quarter came in at 39 million USD, compared to 137 million for all of 2021. Total revenues came in at 68.9 million. Last year it was 272 million. So here's a breakdown of our operating expenses. Our crew costs have remained fairly stable across in Q1 compared to the previous year. Manning expenses went up as we effected more crew changes in the quarter. Lube oils went up as due to the increase in the price of oil. Insurance went up because industry-wide premiums went up. Our stores and spares expenses came down about 20% from 610 to 481. Our overall OPEX per ship per day came down to 4914 per day, which is below our target of 4960 per day per ship. So here's a comparison of our daily operating expenses to the industry average. Now, the last time that the industry average operating expense figures were published was in October of 2021. At that point of time, our operating expenses per day per ship were about $800 per day, lower than the industry average. That translates to an 8 million positive net profit for the year end. Here's financial highlights for the Q1 2022 compared to Q4 2021 and Q1 2021. So total revenues for the first quarter, as I said, came in about 69 million. That's down from a very strong quarter that we had in Q4 2021, which was about 84.5 million, but much improved from the Q1 revenue figure, Q1 2021 figure of 44.5 million. Now that is partly because the markets in Q1 of this year were better, but also partly because in Q1 of last year, we had a number of our ships that were doing low-paying backhaul voyages. That's no longer the case. Net profit for the quarter, as I said, so it's 39 million, up from 12.3 million in Q1 2021, although below the 53 million net profit of Q4. EBITDA for the quarter came in at 49.2 million, down from 62.4 million in Q4 and up from 20.1 million in Q1 of 2021. Our earnings per share came in at 0.83 for the quarter, down from 1.14 in Q4 2021 and up from 0.24 in Q1 2021. And this resulted in a net profit margin of 56.66 compared to 62.76 in Q4 2021 and up from 27.67 in Q1 2021. So as I said, our cash was very healthy, 81 million. Our ships net declined from 605 million to 597 million on account of depreciation. Our total long-term loans, excluding the BNP loan, which we prepaid, or rather including that, came in at 232 million. Total shareholders' equity was up from 429 million to 449 million. Book value per share was 9.59, up from 9.21. Return on equity was 35.55 compared to 34.61. Total return on assets was 22.11 compared to 18.75. Our fleet remained the same, so we continue to have 36 ships. So this over here, the top line over here shows the average age of our ships from 1995 until today. You'll see from 1995 until about 2013 or 2010, our ships were relatively elderly. The average age of our ships was relatively old. Since then, we took delivery of a number of young ships, eco ships, and the average age declined. The ships that we took delivery of were also much larger. So this red line over here denotes the average size of our ships in deadweight. You'll see that it increased quite substantially as we started to take delivery of Supramaxes and Ultramaxes. These are much larger ships than what we were operating previously. This line over here shows the average time charter rate that our ships earned. And you'll see that, okay, so 1995 was a very good market, rates were 7,300. Then you had the Asian financial crisis, rates declined, and then you had China joining the WTO. There was a super cycle, there was a big boom, and then rates were very healthy. Thereafter, you had the order book, which reached 80% of the fleet, following which there was a supply overhang and rates declined right until 2015-16. They bottomed out then. And then ever since then, they've been gradually moving up. Of course, COVID was a speed bump and rates declined in 2020, but otherwise it is more or less as expected. This line over here shows the operating expenses, the average operating expenses for our fleet. You'll see that it peaked in 2009 or 10 when our ships were quite elderly. And now our ships are older. And so there's still, the operating expenses for our ships are still, are much larger. But despite that, the operating expenses of our ships are relatively similar. This shows the debt and the debt to equity ratio over time. So you'll see that our debt actually came down to 0 during the super cycle. We paid off our debt completely, and then we took on debt as we ordered a lot of new ships. We embarked on a fleet rejuvenation plan, and it peaked in 2016 at 482 million, and now it's down to 233 million at the end of Q1. Debt to equity follows a similar profile. So as the debt came down, of course, that ratio went down, and then we took delivery of many of our new ships, and the debt went up again, and then now again it's declining. This is the debt to EBITDA ratio over time. So you'll see that it peaked in 2015-16 again as our debt hit a peak and as we took delivery of a number of ships, but it's been declining since. This shows the net profit and cash profit. Over time, you'll see that there's very few times in our history when our cash profit has been negative. It's only 2 years that our cash profit has been negative. During the super cycle years, our average net profit was in excess of 100 million, and it's been similar, at least in the last 1.5 years. Our net profit last year was 137 million. This shows you our dividends that we have paid since 2003 until now. So our policy is to pay not less than 25% of net profit as dividend. This shows you the percentage of dividends that we paid over time as a percentage of EPS. From 2014 until now, until 2021, we stopped our dividends because of a very poor freight market, but we have reinstated dividends last year. Here's PSL's ESG footprint. So we're always endeavoring to reduce our environmental impact by adopting new technologies. We replaced our older, less fuel-efficient vessels between 2013 and 2017 with eco vessels, which resulted in our grams per CO2 ton per nautical mile reducing from 12.884 in 2014 to 7.42 in 2021. So part of our fleet is retrofitted with fuel-saving devices such as Mavis ducts, and this leads to energy savings of about 3 to 5%, which is fairly significant. We have a formal environmental policy statement since 2009 that's based on ISO 14001 and 2004 standards, and then we updated that to ISO 14001 2015 standards. Now, this is totally voluntarily. This is typically something that tanker companies would have, not companies that are in our sector and the dry bulk sector. We joined the Getting to Zero Coalition as a founding member. This is an alliance of about 150 companies within the maritime sector to explore and develop commercially viable zero carbon emitting vessels. We have an in-house training center plus a full-scale ship simulator to create awareness about environmental issues. Last year, we provided 60,000 free meals over 3 months to COVID-affected communities in Bangkok. We're a signatory to the Neptune Declaration covering seafarer well-being and crew change. We have deviated ships. As part of that, we have deviated ships at huge commercial cost to us to sign up our seafarers during the COVID-19 pandemic. We've been providing scholarships to students at the Merchant Marine Training Center, about 42 scholarships each year since 1995. We also built a $1 million 80-bed dormitory at the Nakhon Si Thammarat Institute. In the first quarter, we provided a Thai baht million donation to the Michai Patana School in Buriram province. We were classified as a company having excellent corporate governance for 12 consecutive years from 2010 to 21 by the IOD. We've earned 100 full AGM assessment score for the 4th consecutive year from 2018 by the Thai Investors Association. We are the only shipping company in the ASEAN region to receive the Asset Class Award in recognition of our having attained a score of about 97.5 in the 2019 ASEAN Corporate Governance Scorecard. And we are also certified as a member of Thailand's Private Sector Collective Action Coalition Against Corruption since August 2019. It's been a very busy period that we've had as far as investor relations are concerned last year, and that continues this year. This shows the total return to shareholders from the time of our IPO in 1993. So if you had invested in an IPO, 85 baht per share, you would have received a 16.5% IRR on your investment. So a very healthy investment over that long period of time. So some final food for thought. So as described in the industry section, demand is growing faster than supply, and that should be good for the next couple of years. And minor bulks in particular, which is cargoes that PSL's smaller ships carry, they are growing faster than other cargoes, and definitely faster than supply growth in the smaller geared sector, which is the sector that we operate in. So we are Thai corporate, but we have zero business out of Thailand. Our business is global. COVID-19 cases spiking in Thailand, weaker Thai baht. This has really not much impact on us. All our income is in USD. We are a Thai stock that is unconnected with the Thai economy. Part of our expenses are in Thai baht, and they would of course reduce with the weaker Thai baht. We believe that price to book value is not a good measure anymore for us, as asset values have gone up since the start of the pandemic by between 100 to 200%. And our debt continues to shrink, and surplus cash generated from our business continues to grow. This is, of course, good news for our shareholders. With that, we open for questions.
ท่านใดมีคำถามก็สามารถส่งคำถามเข้ามาในระบบได้เลยนะคะก็จะเป็นช่วงคำถามคำตอบค่ะโดยค่ะคำถามแรกที่เข้ามานะคะ
Okay, so we've got two questions which have come in on the chat line. I'll just read out the question and then I'll give you the answer. It appears that the average rate in 2022 is higher than that in 2021, and the rate in 2023 looks higher than in 2022. So will the management team be surprised by that, or you have already expected this improvement? So I think it's more of a statement rather than a real question. As far as management is concerned, I think we have always been saying that we should have a couple of very good years, considering that demand and supply balance has been reached, point one. Point two, that the forward order book to existing 20-year forward order book as a percentage of the fleet compared to the existing 20-year-olds of the fleet, for the first time, this ratio is less than 1, starting out at the beginning of 2022 and continuing at the end of Q1, that ratio has become even smaller. The fact that minor bulks is growing at a faster speed than the growth in the smaller sector again tells us that we should have some good years coming up. All these factors put together with the backdrop of high grade of inefficiency in the fleet due to the Russian-Ukrainian war, as well as due to COVID-0 policies in China, these will all remove supply from the market, and as a result, we should continue to have good years in 2022, 2023, and beyond, all the way to 2025. But keep in mind that because supply-demand balance has been reached, you will have extreme volatility. All you need is a little bit of more demand to come into the picture, and rates will spike up sharply. And at the same time, if demand comes down even slightly, you'll have a big fall in rates. So what we notice is that the investors don't really understand this, and therefore when the rates fall, instead of trying to buy the dip, they sell the dip. So therefore it is something that you should keep in mind for the future. The next question is, whether it is correct to say that the European Union's measures, especially to stop reliance on goods from Russia, will benefit the shipping sector, especially dry bulk. Okay, so in this, there are two items. If you remember the first slide that I showed you on the presentation, there are two items that are of really big importance, or three items of very big importance as export products from Ukraine and Russia. The first one, of course, is grain. Whether it's coarse grain or wheat, both of them are a very large export product from Ukraine and Russia. The second item, of course, is coal, energy. It's a big export item out of Russia and Ukraine. And the third item, which is fertilizers, again, is very large export from Russia and Ukraine. Now, when you look at these three items and see where they are going, they're going mainly to very close by ports. So when you remove these items from the play, that means you remove the export of these items, the same countries which are close by in ton-mile terms will have to buy the same cargoes from very far away places. Now we can share with you what's happened to some of our ships which are carrying these type of cargoes, which we would have carried from, say, Russia or Ukraine, and now we are carrying from some other countries like America. Now, what we have noticed is that one of our ships, which is on time charter to someone else, so we get paid every day, has been waiting for more than 2 months at the port of Mobile, which is in America on the US East Coast, and which is a coal exporting port. But they're just waiting for the coal, and it's already 2 months. So not only has the ton mile gone up because of coal exports from Russia being stopped, but it's also resulted in congestion at the alternate load ports like Mobile. The other thing we have seen is that our ships in South America or in the west coast of America loading grain are again waiting for between a one month and 2 months time to load their grain. So again, these ports, East Coast South America or West Coast United States, both are very far away compared to the export points of Russia and Ukraine for the North African coast, which is where most of the grain exported from Russia and Ukraine goes to. So you can see again, not only the ton mile has gone up significantly, but we also see congestion has gone up quite significantly for loading at these alternate ports to carry the same cargo back to North Africa. So both these items have had a big impact on the market. And as I showed you in the presentation, that China's exports and imports have all come down, yet the market has been very strong. And the reason for that is these substitution of Russia and Ukrainian exports from very far away places, and for giving us more congestion in those places, so therefore reducing the effective supply of ships. So both these factors have helped a lot in keeping the rates up very sharply, despite the fact that China has slowed down. And remember, China will start to accelerate once the $2.3 trillion stimulus plan comes into play. Okay, so there's one more question which has come up, whether the increase in oil prices will affect the company's business and how much is the cost increase. So first of all, cost of oil is not on our account. It is on account of our clients. They have taken the ship on time charter, and therefore they are responsible for the oil that is being burned on the ship. Secondly, as the price of oil has gone up very sharply after the war, especially because of the lack of supply from Russia, as a result of that, oil prices have gone up, and therefore the clients have asked us to slow down our ships to the slowest possible level. Once again, creating inefficiency in the supply of ships, again reducing the supply of ships. So again, very positive for freight rates. There's another question, normal dry bulk seasonality. Do you think it can still be applied for this year? Again, if you remember the chart that I showed you of the BDI as of yesterday had gone up to 3,100 points. So again, you can see the seasonality following the same pattern as last year, but stronger, higher than last year. So that's the difference. And of course, if you compare with 2020, it's much, much, much higher. there are no further questions, and I think we are also running out of time. So we can simply thank you for being a very good audience and for listening to us so patiently. Thank you so much, and Sawadee Krap.